Hey, in today's video, we are talking about how taxes affect your retirement. Coming up next. Hey, my name is Mel Stubbs. I'm a financial planner at Christy Capital Management, and today we're talking about taxes and how they affect your retirement. Now, for a lot of people out there, every source of income that you have can be subject to taxation. So let's go through it. First thing we want to talk about is your pension. Maybe you're a federal employee, FERS pension, maybe you've got a different type of pension, but pensions are 100% taxable. Whatever you're earning that year, you'll get a 1099, a W-2, you will pay taxes on it at whatever the current rate is during that current year. 100% taxable for pensions. The next thing up is Social Security. So how much of that is taxable? Well, let's look here. If you were filing individual on your tax returns, if you make $25,000 or less of combined income, then there is no taxation on your Social Security. If you're between $25,000 and $34,000 of combined income, then 50% of it will be subject to taxation. And if your income, combined income, over $34,000, then 85% of your Social Security is subject to taxation. Let's look at if you're married. If you're married, $32,000 of combined income or less, no taxation on Social Security. In between $32,000 and $44,000, 50% of it will be subject to taxation. And $44,000 and higher, 85% of your Social Security will be subject to taxation. If you're a federal employee, if you have a pension, a Social Security, let's say your spouse has a Social Security, you're probably going to be above that limit, above $44,000 a year, where 85% of your Social Security will be subject to taxation. Now, let's put that in a positive light. That means 15% of your Social Security will not be subject to tax, but 85% of it will be. This does not mean that your Social Security is taxed at 85%. No, 85% of that number adds into your income and will be subject to whatever tax rate you land. So wherever tax bracket you're in, that's the tax you'll pay on 85% of your Social Security. Next, let's look at your traditional balances, whether it's traditional TSP, traditional 401k, or a traditional IRA. Anything traditional has not been taxed yet, so every distribution you take will be 100% taxable in the year that you take it at the tax rate of that year. So if it's 20 years from now, you will pay the tax at whatever the rate is 20 years from now. And so as you can see here, pensions are taxable. Social Security, for most of you, it's going to be taxable. IRA, traditional TSP, those balances are taxable. If all of your sources of income are taxable, then you have a lot of tax rate risk. If taxes change, it affects you greatly. Now, what is not subject to taxation? Let's look at Roth IRAs. So any distribution you take from a Roth IRA is not taxable. Now there's two requirements. You got to be over the age of 59 and a half to take the distribution, or you have to have had the account 5 years, whichever comes later. So, for me, I got to wait until 59 and a half. If you're 59 and a half already, but you have no Roth account, then you need to set one up, and you can touch your earnings after 5 years. Now, another caveat here, you can touch your contributions, you just can't touch the earnings. The 59 and a half and the 5-year rule only counts towards earnings. You can touch your contributions, your conversions anytime. You just can't touch the earnings. But for the vast majority, you're going to meet those two requirements easily. And so a Roth IRA, Roth TSP, if you take a distribution out, it is not taxable. And so much the same way that it makes sense to have some conservative money and have some aggressive money, so that when you need to take a distribution, you have a choice. Do you want the distribution to come from conservative? Do you want the distribution to come from aggressive? In the same way, it makes sense to have some traditional money and have some Roth money. And when you need to take a distribution, you can look at your tax situation for that year and decide, let's just say I need to take a $10,000 distribution. Does it make sense to take it from traditional, or does it make sense to take it from Roth? You have a choice as long as you have two options available. If you don't have any Roth, then you don't have a choice. And if you need a distribution, it has to come from traditional, which means it's taxable at whatever the tax rate happens to be at the time of distribution. Well, maybe some of you are looking and going, well, man, I need to have more Roth. Either I don't have any or I don't have much. Well, there's two ways to get more Roth. You can contribute more. So whether you are writing a check contributing to a Roth IRA, or maybe you're through your paycheck contributing to Roth TSP or a Roth 401k, you can get more Roth through contributions. However, there are some limitations. You can't just write a $100,000 check and put it in your Roth IRA. There are limitations each year. So if you want to move a lot of money, get a lot of money in Roth, contributions isn't the way to get it done. The way to move large chunks of money over is to do a Roth conversion. A Roth conversion is where you take traditional money, you move it over to Roth, pay taxes in this year, and once it's in Roth, it's going to be tax-free as long as you play by those two rules, 59.5 and 5 years. So then the next question we hear is, great, I have TSP, I have some 401k, I want to move that to Roth. Well, here's the dilemma. Most employer plans, now for federal employees, the TSP, it's not allowed. Most 401k plans, if you're not a federal employee, most of the time it's not allowed. These are set up to help you contribute, you get a match, it helps you save money. They aren't meant for you to do fancy tax planning. So if you want to do a Roth conversion and take money and shift it over, a lot of times you're going to have to move it out of the company plan, out of the TSP, out of the 401k, move it to an IRA, and in an IRA you can do these things. Well, let's look at an example here. You had $100,000 of traditional money in a traditional IRA. You want to shift it over to Roth. So as the $100,000 moves over to Roth, you can see $25,000 leaves for taxes, $75,000 shows up in the Roth account. Now the $25,000 is an example. Let's say you're paying 20% federal, 5% state. This is just for an example. We're saying $25,000 going for taxes. Your taxes would be based on where you live and your tax bracket. Now some would say, wait a second, my $100,000 just moved over and now I only have $75,000. I just lost $25,000. Now I would argue you didn't lose $25,000. The $25,000 is the government's portion of your money. Remember, the traditional money, you haven't paid taxes yet. This was a paycheck that instead of you getting a paycheck, you said, wait, hold on, send it to my traditional account, I'll pay taxes later. So now that it's grown, when you take it out, it's your paycheck. And so the way I look at it, your $100,000 didn't lose $25,000 and you have $75,000 in the Roth account. You just were choosing to pay the taxes now. But the traditional account is infested with taxes. There's a whole bunch of tax money in there. You're just holding it for the IRS. So yes, on paper, it looks like your $100,000 went to $75,000, but the truth is your $100,000 wasn't your $100,000. The $25,000 of taxes was in there the whole time. You're choosing to shift it now to pay taxes today because you know what today's rate is and you're afraid that later taxes may be worse. And so that's why people are doing Roth conversions. Roth conversions let you move lots of money. You can move as much as you want to, realizing that whatever you move, it is moving you up the tax bracket and you will pay whatever the rate is for that year. So if there's any limitations in Roth conversions, it's because you're putting the limitation on yourself. You can do as much as you want. It's that tax bracket that's going to limit you and make you not do too much. So everybody wants to pay lower taxes. So then here's the question. Do you want to pay lower taxes this year, or do you want to pay lower taxes in your lifetime? Roth conversions mean you're going to pay more taxes this year than you ordinarily would have. But the hope is that you're going to pay lower taxes in your lifetime because you're going to go ahead and pay it now. There are two sweet spots in the tax brackets. So let's look here at the tax brackets. You can see it starts off with a 10% bracket, 12, 22, 24, 32, 35, and then there's a 37 as well. There are two sweet spots in the bracket. If you'll look between the 10% bracket and the 12% bracket, it's only a 2% increase. So you have a lot more room where you could Roth convert more money and you're only going up 2%. Now when 12% goes to 22%, that's a big jump. But then look, from 22% to 24%, that's also a small incremental change. So those are the two sweet spots. If you're in the 10% bracket, maybe you max out the 12% bracket because it's not that much extra tax and you can move a lot more money. If you're in the 22% bracket, maybe you max out the 24% bracket, you can move a whole lot of money to Roth and you're only going up 2 percentage points on the tax bracket. That's not that much, and those are the two sweet spots. If you're worried about taxes, you want to do some planning, you're not sure how, jump on over to christycapital.com. Check on the Talk to an Advisor. Call the number on your screen. We would love to help you in any way we can. My name is Mel Stubbs. I will talk to you next time. We have to cut into this video to do the proper disclaimers. The purpose of this video is not to give specific tax advice or investment advice. We are going over general principles and ideas that can be used, and if used correctly, can save and avoid taxes. You are going to want to work with someone personally that knows your situation personally, so seek out advice from an independent financial advisor. This is for educational purposes only.